If you're planning to do a Roth conversion this year, you might be setting yourself up for a nasty surprise on your Medicare premiums 2 years later. Most retirees don't see it coming, and by the time they do, it's too late to fix it. I'm talking about an extra $3,000, $5,000, even $7,000 a year in Medicare costs that could have been avoided with better planning. Hi, I'm Mark Wisniewski, president of Southern Incomes. Today, I'm going to show you exactly how Roth conversions can trigger massive increases in your Medicare premiums, and more importantly, how to do conversions the smart way so you don't get blindsided. If you find this helpful, like and subscribe. And if you want personalized help navigating this, there's a link in the description to book time with me. First, let's talk about why Roth conversions remain a major planning focus right now. More retirees than ever are converting money from traditional IRAs and 401ks to Roth accounts, and for good reason. Roth accounts grow completely tax-free. You never have to take required minimum distributions from them. And when you die, your heirs can inherit them tax-free, which is a huge benefit if you want to leave a legacy without burdening your kids with a big tax bill. Here's the common scenario. You're 60, 62, maybe 65. You've retired or you're about to. Your income just dropped because you're no longer working and you're sitting on a big traditional IRA, maybe $800,000, maybe $1.5 million. And you know that money is a ticking tax bomb. Every dollar you pull out in retirement gets taxed as ordinary income. So your advisor, or maybe you, decides this is the perfect time to do some Roth conversions. While you're in a lower tax bracket, you go ahead and you convert $50,000, $100,000, maybe even more. You pay tax now at 22% or maybe even 24%, and boom, that money grows tax-free forever. It is a smart strategy, but if you don't plan it right, you could end up paying way more than you bargained for. Second, here's what most people don't know about Medicare costs. When you think about Medicare, you probably assume all costs are pretty much the same for everyone. Part B costs this much, Part D costs that much, and that's it. But that's not how it works. Medicare has something called income-based premium adjustments. What does that mean? Well, basically, if you make too much money, you're going to pay extra, a lot extra. For most people, Medicare B costs just over $200 a month before any income-based surcharges apply. But if your income is too high, that number can jump to $284, $406, $528, $649, and even $690 per month per person. If you're married, you're paying that for both spouses. And the same thing happens with Part D prescription drug coverage. Those surcharges sure add up fast. Now, here's the part that trips up most people. Medicare doesn't base these surcharges on your current income. They base it on your income from 2 years ago. So what you earn in, say, 2026 determines what you pay in 2028. That 2-year look back is the silent killer. Third, here's the trap most retirees walk into with their Roth conversions. Let's say you're 64 years old, recently retired, and now you're navigating Roth conversions in today's higher tax environment. Your income dropped from $150,000 a year to maybe $40,000 from a pension or maybe some part-time work you're doing. You think, perfect, I'm in a low tax bracket. This is the time for me to convert. So you convert $120,000 from your traditional IRA to a Roth, and you pay about $26,000 in federal taxes on that conversion. Not fun, but you understand it's part of the plan. What you don't realize is that that conversion just spiked your modified adjusted gross income for 2026 to $160,000. Now, fast forward to 2028, you're 66, you just enrolled in Medicare, and you get your first premium notice, and you're paying $528 a month for Part B alone, instead of that $203. Your spouse is paying the same. That's an extra $7,800 a year each year for the next few years, all because of one Roth conversion you did 2 years earlier. And here's what really stings. If you had just spread that conversion over, say, 3 years, $40,000 a year instead of $120,000 all at once, you might have stayed under the income threshold and avoided the surcharge entirely. Fourth, let me show you how the actual income thresholds you need to watch. For 2026, if you're married filing jointly, here's how Medicare surcharges break down. If your modified adjusted gross income is under $218,000, you pay what's called a standard premium. Once you cross $218,000, you jump into the first surcharge tier. And then there are additional tiers at $274,000, $342,000, $410,000, and above $750,000. These income thresholds are indexed, and that can change slightly each year, but for the most part, the surcharge structure itself remains the same. For single filers, the thresholds are roughly half. Under $109,000, you're good. Over that, you start paying more. The key is knowing where you stand and planning your conversions so you don't accidentally push yourself over the edge, because once you cross a threshold, even by one single dollar, you're paying the higher premium for that entire year. Fifth, here's how you navigate this like a pro. Strategy number 1, spread your conversions over multiple years. If you're planning to convert a $200,000 total, don't do it all at once. Maybe you do $50,000 this year, $50,000 next year, and so on. This keeps your income more consistent and helps you stay below the Medicare surcharge thresholds. Yes, it takes longer, but the tax savings and the Medicare savings combined can be huge. Strategy number 2, time your conversions around big income changes. If you're planning to retire, sell a business, or stop taking consulting income, those are great years to look at conversions. Your total income might still be low enough to avoid triggering the surcharges even with the conversions added in. Strategy number 3, use the appeal process if life changes. Medicare allows you to appeal your premium surcharges if you've had certain life-changing events like retirement, divorce, death of a spouse, or loss of income-producing property. A lot of people don't even know this exists. If you retire mid-year and your income drops, you can file an SSA 44 form and request that Medicare use a more recent tax year to calculate your premiums. It's not going to be automatic, but it can sure save you thousands. Strategy number 4, model it out before you pull that trigger. This is where working with someone who understands both the tax side and the Medicare side is absolutely critical. You need to run the scenarios. What happens if I convert $60,000 versus $80,000? How much will I save in taxes over the next 20 years? How much will I pay in Medicare surcharges? What's the net benefit to me? Sometimes paying the surcharge is absolutely worth it. Other times it's not. You won't know until you do the math. 6, don't let the fear of Medicare surcharges paralyze you. Here's the thing. Yes, these surcharges are real. Yes, it can be expensive, but paying an extra $3,000 or even $5,000 in Medicare premiums might still be the right move if you're saving $20,000, $30,000, or $50,000 in future taxes. The worst thing you could do is avoid Roth conversions entirely just because you're scared of the surcharges. The key is to be strategic, plan for it, factor it into the decision, and if the numbers work, move forward with confidence. Remember, Medicare premiums are just one piece of the puzzle. You also have to think about future required minimum distributions, tax brackets in retirement, your legacy planning, and what tax rates might look like 10 or even 20 years from now. Roth conversions are one of the most powerful tools that we have in retirement planning, but only if you use them correctly. Seventh, understand that this gets more complex if you have other income sources. If you're collecting Social Security, taking pension income, earning rental income, or maybe you're still working part-time, all of that stacks on top of those Roth conversions. So it's not just the conversion amount that matters, it's your total modified adjusted gross income for the entire year. That's why cookie-cutter advice does not work. Your situation is different than your neighbor's. What works for, someone with $500,000 in IRAs and no other income is completely different from someone with $2 million in IRAs, a pension, and rental properties. You have to look at your full picture. If you want help building a Roth conversion strategy that factors in Medicare surcharges, future taxes, and your complete retirement income plan, book a call with me using the link in the description. Let's make sure your conversions save you money, not cost you more than they should.